Matching concept. Expenses should be matched with revenue, or we take the expense for a period. These are two kinds of expenses matched with revenue. What does this mean? Suppose we buy 1,000 units of an item for trading purposes and we sell 900 units. We have a balance of 100 units left with us. When we compare, when we say, suppose we take a cost for this and we take 1,000 into 100, 1 lakh, and let us say 900 units are being sold at the rate of 200, then we have 1,80,000. To compare the cost of 1,000 units with the selling price of 900 units is not correct. It's not matched. There is a mismatch here. If we compare, in order to ascertain the true profit, we have to take the sale of, this is sale, 900 units into 200, we are talking of 1,80,000. Compare it with 900 units of 100 each, 90,000, we get a profit of 90,000. This is a matching concept where when items are sold, it should be matched with the cost of these items closed. So what happens to the balance of 100 units? This 100 units is not an expense because it is going to be sold in the next year. We call it an expense for the next year and therefore it is an asset in the current year. It's not an expense. It is an expense. It is not an expense for the current year. It will be an expense for the next year. This is called closing stock. This is a closing stock, closing inventories. It would be taken as an asset in the balance sheet and in the next year it would become expense. So expenses are matched with revenue. That is one concept. And also it may not always be possible to match like this. So certain expenses like let's say rent and telephone charges, electricity, etc. The expenses for that period are charged to that particular period. Salaries for the period will become expense for the period whether or not we have made actual payment. Rent for the period will be expense for the period whether we have paid it or not. Similarly, if we have paid rent in advance and it is for the next year, that will not be treated as an expense in the current year. So the matching concept is actually a combination of the accrual concept and the periodicity concepts, because we have split the entire going concern, the entire life of the cycle into certain periods, annual periods where we determine the performance. Every period, every accounting period, we need to ascertain the expense, the income in order to arrive at profits. So the matching concept in a way is a combination of the accrual and the periodicity concept. So what do we match? We match the sales with the cost of sales, the revenue which is generated and the costs which are used to generate this revenue. If costs are incurred which will generate revenue only in later years, then that cost should be carried forward to later years. It should not be called cost or expense in the current year.